Hi, everybody. I made this presentation for my individual project in accounting ethics class, spring 2023, Professor Bennett Tchaikovsky. My subject is about Luckin Coffee financial fraud. It was established in 2018, undervalued in 2019, and it was settled in 2020. Luckin Coffee establishment and operation. Luckin Coffee began as a beverage retailer of coffee and tea in China, established in January 2018. After some first stores in Beijing, China expanded to 4,507 stores in 2 years followed. At that time, by most accounts, Luckin is the largest coffee chain by number of stores in China, rapidly increased sales revenue to more than 1 million US dollar by fabricating untrue statement from April 2019 to January 2020 regarding revenue, expenses, and net loss. Um, Impressive growth in efficiency. Look at coffee locking growth metric. Soxer quarter 3 2018 earning release, you will see store number grow 209%, and it increased nearly 400% in customer per store and whopping 557 increase in revenues. Luckin claimed that they have 40 million customers at the end of 2019. That is incredible. In this case, the related parties are Luckin Coffee, Security and Exchange Commission SEC, Luckin Senior Management, Luckin's Board Director, Muddy Water, LLC, Audit Committee, Internal Auditor, and External Auditors. In this list, the two parties that I wanted to tell more about are Muddy Water and the external auditor Ernst & Young. I will tell you more detail later. Now we go to Luckin Board of Management. You will see they are proud and blue. Now is set to leave and the blue is set to remain. At the active time from 2017 to 2020, they show the chairman, Lu Changyao, and Jenny Chen, who failed to maintain the strong internal control. So they are set to leave. And the other Guo Jinyi, Gao Wenbao, Hu Kang, and Wai Wenchong are remaining in board management to lead the company. So we will have a question. How did Luckin make fraud? in their financial statement. First, they fabricated sales and revenue. Luckin Company rapidly increased sales revenue by two ways to record consumer product sales. They go by using the digital payment platform as WeChat Pay and Alipay. They redeem coupon through Luckin's app, and that reset Luckin's fabricated sales, and they switch the source of data. Luckin had a specific way to calculate their revenues from the sales of coupons based on the number of redemption instead of the actual number of coupons sold. They create fake customer to reach the expected sales. The fake customers are individual customers, the employee, the corporate customer, and the third-party shell company that they created and control. Luckin used intermediate agent to resell coupons to fake customer, and Luckin employee will redeem coupon and make fake order, fabricating coupon sales and revenues. Then they change the actual business operation database to the fabricated database to conceal the financial department. Next, they fabricated expenses and return fund. They return money to fake customer. They recorded outflow as expenses. They set fake cost and fabricated costs and expenses to have precise revenue. Luckin return fund to the funding companies through bank transfer and fabricated expenditure. Business-related expenses as set out in the financial statement show that there were payments to vendor, including supplier. However, this vendor did not provide any services or products to Luckin in return. Luckin also fabricated costs so that they were consistent with overstated revenue. In 2019, the total fabricated expenses and costs were around $196 million. IPO launch event, they earn earning and equity offers, bonds, publishing information to the IPO market. In May 2019, within 18 months of Luckin's grand opening, the company launched its IPO of American Depository shares in the United States and listed on NASDAQ. Stock price at initial publishing was 17 and jumped up to nearly 50 at the end of 2019. Luckin made roughly $600 million from investors. Luckin also reported revenue reaches USD 71.3 million in first quarter of 2019. Company's estimated market value increased from 1 million in July 2018 to 3.9 billion in May 2019. The public report of Luckin's rapid growth pushed the value of the company to $5 billion. Luckin's enter in IPO market. In the chart, you will see the rise and fall of Luckin company from May 2019 to May  2020. and the analysis of earning and call for investment capital are from source from the SEC complaint report civil action number 20 CV 10631. Only in third quarter of 2019, Luckin's revenue and expenses were overstated by 45% and 24%, and its net loss was understated by 24%. Further, Luckin's share price increased 60% from IPO price at the end of 2019 from 17 to $28. The fabricated sales and expenses in the fourth quarter of 2019. The share price increased 100% from IPO price to nearly $34 per share. Equity offering and bond issuance in January 2020. Luckin obtained an equity offering and convertible bond offering about 418 to 446 million. Within only 8 months of Luckin's IPO listing, the company's stock price increased approximated 200%, $50 per share. So, who exposed Luckin's financial fraud to the public? Muddy Water LLC. Muddy Waters is an investment research firm based in the US. It conducts research about financial fraud. First, they receive an anonymous report together with supporting evidence in January 2020, alleging the fraudulent conduct of Luckin. They publicly posted this report to its Twitter account. Then Muddy Waters said it decided the share price of Luckin would drop, and they had sold short Luckin share after releasing the report to the public. That led to the outcome that the company was delisted from the Nasdaq on 29 June 2020. Luckin was investigated by the US SEC and the China State Administration for Market Regulation. Luckin was committed misconduct constituted fraud. April 2020, their share sank 81%. Luckin also conducted an internal investigation in April 2020. SEC finalized investigation and announced the penalty against Luckin on 16 December 2020. Luckin agreed to settlement, including permanent injunction and paid $180 million in monetary penalty. So, what is the ethical responsibility? Luckin's ethical failure was that lack of integrity and competitive justice. The management misrepresented the company. They intentionally produced false accounting documents to mislead investors in their own advantage. Their failure in spot unethical practices. Ethics analyzes this case includes all levels of a company, including senior management, board of directors, audit committees, internal auditor, and external auditor. They are dishonestly abusing position of power and failure to fulfill fiduciary duty. They violated code of ethics. An audit committee has a duty to apply the code of ethics and ensure the company acts honestly and keep independent in its relationship with the management. However, in this case, the audit company kept silence and failed to notify the board of potential ethics infringement. Talking about the conflict of interest. External auditor Ernst & Young for the year 2019, Ernst & Young wrote a private letter to banks that there were no problem with Luckin's finances while they did not audit Luckin's 2019 financial statement. Early year 2020, Ernst & Young stated that they identified the inflated financial reserve and reported it to the board. Although Ernst & Young noticed the fabricated statement and discovered the fraud, Ernst & Young chose to quiet withdraw as an auditor from the client, possibly due to a conflict of interest between the firm and its own investor. They did not report the potential fraud to the regulator. Because of the advantage, they violated the ethic to act ethically by exercising the good judgment. Conclusion. Evaluation. Several parties are responsible for the accounting scandal and fraud at Luckin. Luckin should have established and applied more robust code of ethics throughout the company, from the senior management to frontline staff, in order to detect fraud at an earlier stage and to remain consistent with commutative justice. For external auditor, they should have been more proactive and raising red flags regarding the company's misconduct, as well as avoiding guaranteeing financial performance to other parties until the firm had conducted its due diligence. The regulation in China and US should have ensured that Luckin fulfilled its duty of integrity and transparency before listing. Recommendation. First, increasing regulators' power of enforcement could expedite the investigation process and minimize the negative impact of fraud. Second, providing more fraud detection training for auditors would increase their skills and ability to spot improper transactions. Third, increasing transparency and stringent vetting of internal audit system would help auditors make balanced judgment from all perspectives. Finally, lessons from the Luckin case raises awareness about the importance of multi-level cooperation in the company's financial ethics and moral culture. That is the end. Thank you, Professor Tchaikovsky, and everyone for taking time to listen to my presentation. I hope you have a good day and bye, everyone.